If you're retired from work or you're about to retire from work in a few months, maybe you're gonna like this video. The 7% tax rate is a special tax regime in Italy just dedicated to people retired from work, and it's often known as the flat tax or the flat tax rate scheme. And it works like an exemption provided by the law with the goal of attracting people from abroad, retired from work, to southern regions of Italy. And it offers mainly a 7% tax rate on foreign income, so listen carefully, no wealth tax due, just your personal income. And this option is time limited to just 10 years only. And to qualify for this 7%, of course, there are a few requirements to be met. People must not have been tax resident in Italy for at least 5 years preceding their relocation. They must transfer their tax residence to Italy according to Article 2 of our tax code, meaning Italy must become your primary place of residence for tax purposes, also according to the famous tiebreaker rules, I should say. And this scheme typically applies to individuals who receive significant pensions abroad or they have, huge portfolios. And the flat tax scheme applies for a duration, as I said, of 10 years, but I should say more correctly, 9 plus the year in which you become a tax resident. And any kind of pension qualifies. Or let's say 99% of the foreign pension could qualify for that. And any kind of foreign income could benefit from the 7%, so dividends, rental income. But it must be a foreign source. This is the main rule. And after the 10-year, once that the time frame expires, people still committed to stay here in Italy will be subject to the regular Italian tax rates, unless an exemption is provided, unless there is some extension on the go. There is no update about this yet. And the 7% tax rate applies specifically to the income earned outside of Italy, and this includes pensions of any kind, dividends, interest, rental income, capital gains, and other forms of income sourced from abroad. And income earned within Italy, well, it's excluded, and it falls under the Italian rate. It could be the dry coupon, 21 or 26%. It could be 23 to 43%. So be careful if you want to put your Italian property on Airbnb while you come back home for a few weeks during the summertime, okay? Retirees must establish the tax residence in Italy to qualify for the flat tax scheme. And this involves making Italy their primary place of residency for tax purposes, which may require some kind of documentary evidence to prove in case of audit, proving your rental agreement, proving you filed the 5 tax years abroad, and so on. And by the way, the list of cities available is not that long, honestly, considering the majority of them have a population limit below the 20,000 inhabitants. Those who are interested in this kind of benefit, and those who are committed to benefit from this kind of benefit by the end of 2024, for example, need to apply the tax scheme through the Italian tax authorities. And they need to file a tax return the following year in which they become a tax resident. And listen carefully, there is no form to sign before moving to Italy, just to clarify some very recurring issues and questions that we hear over and over. The tax liability under the 7% tax rate is pretty straightforward. It's estimated on the total sum combined of the total foreign income earned by the people retired for work. And this income is under the 7% tax rate, flat one. And if you compare that to the IRPEF brackets, it's way less than 23%. It's way less than the 43%. However, there is no tax credit given for foreign taxes paid. So it could lead to a potential dual taxation here and there, unless, of course, there is a tax treaty providing something different, or there are some local regulations in your home country that can dictate a different approach. The flat tax scheme, of course, clearly offers several benefits. It gives you a simplified tax regime, reducing the complexity of the tax return, and I might say the cost of the tax filing per se. It's willing to take retirees from their countries to choose Italy as their retirement destination, and clearly the trade-off for Italy is that they're going to put money not for taxes but in the economy circle. And People who benefit in this, flat tax scheme are required to file their taxes by the following June of the year in which they become a tax resident. And it's called Modello Redditi. And it's an annual tax return. And they report their foreign income combined. If you fail to comply with these requirements, if you skip the deadline, results are not just penalties or fines, but what's at risk is you're going to lose the benefit forever. And overall, the 7% tax rate for people retired from work is a very interesting option for people with, as I said, foreign income, significant portfolios, profiling them with a very favorable tax regime. And I might say it's a very attractive way to make people taste the Italian life. And if you leave earlier, it's not a big deal. You don't have to give the money back. So it seems like if you retire for work, the 7% looks like a no-brainer to you. So when it's not a good fit? Let's say you receive foreign income that is considered exempt according to Article 18 and 19 of the OECD agreement. Or let's say that you don't have such a big portfolio over there and you just cashed out everything before moving to Italy. Or simply, you don't reach a certain threshold and applying for the foreign tax credit could lower your tax rate even less than 7%. I have a question for you. How does it feel like to move from a city with millions of people to a small village where basically everyone knows each other's names? How would you manage the lack of transportation, lack of hospitals, and being far from Milan, Florence, Rome? This is my honest advice. And when you manage your tax plan, when you're planning to move to Italy, you can definitely estimate your taxes the best way possible according to real numbers. And remember, percentages per se are just smoke and mirrors. But most of all, your goal should be to understand what the 7% brings on the table and what does not.